Hello, everybody, and welcome. This is my third attempt through this, and I haven't even gotten past the first question, but let's go ahead and have some fun. This is Wiley Solution Walkthrough Accounting Tools for Business Decision Making. This is the 8th edition, and we're going to do a walkthrough today of exercise 25-2. So the question used in the presentation is copyright 2022 by John Wiley and Sons. The authors of this textbook are Paul Kimmel, Jerry Weingant, and Jill Mitchell. All rights are reserved. It's for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay. So when we're doing this question right over here, so we've got Doug's Custom Construction is considering 3 new projects, each requiring an investment of $22,000. Each project will last for 3 years and produce the following annual cash flow. So the equivalent salvage value is 0, and you use a straight line. That doesn't really matter to us because when we're looking at things like payback, really focused over here on in terms of like when are we actually going to be getting our cash back. So this is the cash flows for each one of these. This is the annual, and this is the cumulative. Okay. So when you see this, right, well, how did we get to the annual and then to the cumulative? Well, the annual of the first year is 7,000. Well, then my cumulative is 7,000. If my cash flows here were 9, then 9 plus 7, which is the prior year, is going to give me 16,000. Over here, well, where did the 28,000 come from? Well, it was over here with 16 plus 12, which is going to be giving me 28,000. Okay, so that's what this means. Now, the reason why this is important is because when we're looking at the payback period, what we're trying to do is using absolute dollars. So we're not going to pay attention to any type of interest rates. When does this project make back its $22,000 investment? So when we look at this over here, well, it made back 16,000 by year 2. And now, well, when did it achieve back? How did we get to 20? At what point in time did we get to 22,000, right? So when did we reach this? So we know that the payback period is going to be at least 2 years, right? Because by the end of year 2, we're only at 16,000 cumulative. So now what we have to go through and do is to figure out, well, over here, we've got this, we're at $22,000. So how do we go through and kind of figure out, well, at what point in time do we make back this 22,000? Now, what's really important is that we know this happened at some point in time during the second year, but at what point in time? And we're also making the assumption that we're earning back our cash flows basically evenly. So what we're going to do is we're going to basically say, okay, we're going to take the payback amount or the investment, which is going to be 22,000, and we're going to subtract it from the cumulative prior year amount, which is going to be 16,000. So the amount that we need to go from 22,000 to 16,000, or how much more beyond this to break even, this is going to be $6,000, right? So 22,000 minus 16. What we're then going to do to get the fractional year amount is we're going to divide this by the year 3 cash flow, because of at what portion in time did we actually go through and get back this 6,000. So my year 3 cash flow is going to be 12,000. So this is going to give me the partial year amount, or 0.5. So my payback period for project AA is going to be 2.5 years. Or when do I make back the 22,000? It's after these first 2. And then it's really, if you think about it, well, it's another 6 grand. So that 6,000 is kind of halfway in between these 2 amounts. So let's go ahead and use the same logic. and go to the next set of questions here. So right over here, if we kind of use the same methodology, at what point in time are we going through and earning back the amounts? Well, as we look at this over here for project BV, it's going to be around sometime in here. So let's go ahead and do this. So my investment, which is 22,000 minus the cumulative prior amount, right? And what I mean by this is we're at 22,000. So the prior year cumulative amount is going to be 20. And then I'm going to divide this over here by the year 3, or basically the year following cash flow. Or so why don't we call this the year cash flow, the annual cash flow, where break even was achieved. This is going to be year 3 for project AA. So this over here will be year 3, and this is going to be the amount is going to be 10,000. So what we're going to do here is we know that this project, just like the one above, has been at least 2 years. But as we come over here for this final incremental part, we know that we have to get to 2,000. So this is going to be 2,000 divided by 10, or 0.2. So my payback period is going to be 2.2 years. Okay. Now for this final one over here, if we notice, this is a little bit different. Why is it different? It's because we're actually getting paid back by year 2, or somewhere between year 1 and year 2. So we're right actually in this part right over here. So my investment amount, so we know it's going to be between 1 and 2 years. We know it's going to be at least a year. My investment is still going to be 22,000. I'm going to subtract the cumulative prior year amount, which in this case is going to be 13,000. And then I'm going to divide this by the annual cash flow, year 2. Okay, so this over here is basically going to be 22,000 minus 13,000, or 9,000. And then I'm really, because I'm making it during this year, I'm going to divide it by that cash flow in year 2. So this is going to be 0.75. So the payback period is going to be 1.75, or basically, when do I earn back the 22,000? Well, we know it's beyond a year because we only made 13,000 at this point. And what we're trying to do is to kind of go over here and figure this part of it out. Okay, so that's fine. So I really, if you're taking my class, I don't really care about this part. This is something I'm making just on behalf of Wiley. So if we looked at this over here, the most desirable project and the least desirable project using the method. Well, the most desirable will be the one that gives us the cash back the quickest, which is going to be project CC, which is giving us cash back in 1.75 years. The second most desirable is project BB, and this is going to be 2.2 years, right? So we know that over here for project BB, we didn't earn it back until we got into after the second year. So this over here is going to be 2.2 years, and then the least desirable is going to be project AA at 2.5 years. Okay. Now, all of that is well and good, but frankly, to me, what we just went through and did is more of an academic exercise than something you would really be seeing in the real world. Why is that? Because there is a value associated with money. It is basically what we call the time value of money. Now, if you're not good with present value, admit it to yourself. And what I would suggest doing is I have a sequence of videos that cover bonds that go through this, from financial accounting go review it, because if you're taking my class, you're going to have to know how to do present value for exams. So how do we calculate net present value? Well, when we look at net present value, what becomes really important is in year 0, we know that we're outlaying $22,000. But we know over here for year 1, year 2, and year 3, for example, over here, project AA, this has cash flows of so basically AA for year 1 is 7,000, year 2 is 9,000, and then year 3 is 12,000, right? So this is how the cash flows. But however, what's really important is that if I'm trying to earn 12%, well, what's $7,000 worth today? Well, if I had $7,000 today, a year from now with interest, this would now be worth $7,840. So what I have to do, because these amounts in the future are being paid to me in the future, I cannot compare them to the amount that I'm outlaying now. The process of net present value is what we're doing is we're basically saying, okay, we're paying out $22,000 now. Well, what's this investment going to be generating for us? So what I need to do is I need to bring these values back to today. So over here, how do we do it? It's with the present value tables. And if we come over here and we look at these present value tables, right? So I come over here, let's take a look at our first one right over here. If I'm being paid $7,000 1 year from now, what is that worth in today's dollars? Or how do I make it comparable to this? What I need to go through and do is I need to say, okay, present value of $1, 1 period at 12%. And what this is going to do for me is this is going to say 0.89286. When I multiply 7,000 by 0.89286, this gives me 6,000. Did I do that right? 0.89286. Sure. This is going to give me 6,250 in today's dollars, right? So that means I can now compare it to this. But really, what does it mean? Well, if I took year 0 at 6,250, and if I earned 12% on that amount, this would be $750. So after the end of a year of investing this money, this is going to be worth $7,000. So this is why I have to use present value, right? This is what it does. I'm taking a future dollar amount and I'm bringing it back into today's dollars. That's all I'm doing. Let's go ahead and look at the next one. Since this is being paid 2 years from now, what I'm going to go through and do is I'm going to say present value of $1, 2 periods at 12%. So I'm going to do over here is I'm going to come over here and say 0.79719. And this is going to give me 9,000 times 0.79719. And I get 7,175. Well, does this make sense? Well, if in year 0, I have 7,175, right? I'm now able to compare this to this. That's what we're saying. If I'm making 12% interest on this amount, that's going to give me $861. So by the end of year 1, I'm going to have my initial investment of 7,175 plus the interest I just earned, right? So now I've got 8,036. If I invest this again at 12%, I'm going to get 964. And so then by the end of 2 years, this is going to be at $9,000. So that's why we go through and use present value. So we're going to do the same thing over here. Present value of $1, 3 periods at 12%. So if I come over here, 3 periods at 12%, this is going to be 0.71178. And if I multiply this over here, 12,000, times 0.71178, I'm going to get 8,541. And if I do the same thing right over here, this is going to give me 1,025. So at the end of year one, it's 9,566. Or 8,541 plus 1,025 is 9,566. Over here, multiply this again by 12%. This gives me 1,148. So at the end of 2 years, this is now worth 10,714. If I do this again, it's now going to be worth 1,286 or 12,000. This concept of present value, if you don't understand it, learn it now. It is extremely important, especially if you're going to be doing anything in intermediate accounting. Discounted cash flows are going to be seen everywhere throughout your career. Okay, so we've done all that part over here. And let's now go over to our next part. So now that we have over here, well, how do we go through and determine the net present value? Well, the net present value is basically going to be the sum of the year 0 plus 6,250 plus 7,175 plus 8,541. So my net present value of project AA is going to be negative $34. Well, that's fine. It doesn't clearly meet this criteria. So let's just move on to the second one. So again, I can add up these numbers together now. And the reason is because now these numbers are future numbers. I've brought these back to today. How do I know that they're right? Well, if I'm showing you over here how they're being invested and how they're growing, that's where we're getting those numbers from. Okay, now that we have this all set up, we can now go through over here and now just do the same thing for project BB. So let's go ahead and take a look at project BB, and we'll just go ahead and copy the same thing over here. And we'll just relabel this BB, BB, BB. And with project BB, we still have the same 22,000 going out, but this is all now 10,000 per year. Okay, so our net present value is 2018. Do the same thing over here. Let's go to project CC. So over here for CC, CC, and CC, this is going to be over here. The cash flows were 13, 12, and 11. Okay. Oop, hold on. Okay, so 13, 12, and 11. And so now we have a present value over here of 7,003. So again, why did, if once we have the factors, if these are going to be at 12%, I'm always going to be using the same ones. When you read a present value table, number of periods is at 1, over here at 12%. So 1 period from now, this is 0.89286. 2 periods from now, 0.79719. Remember, the present value of a dollar is for a lump sum. It's a one-time dollar amount. Now, if we have a situation, so right over here, let's kind of going through our analysis, right? Which one is going to be the most desirable? Well, over here, project CC from a net present value perspective is going to be 7,003. Over here, the second most desirable is going to be 2018, which is from project BB. And the last one over here, our least desirable, is 34. So it didn't really change anything that we were going through and doing. Now, the one thing I do want to show you is that there are 2 different types of present value tables. There's a present value of a dollar, and then there's a present value of an ordinary annuity of a dollar. What's the difference? If I have a situation where the payments are the same every single year, what I can do is I can use the present value of an annuity of a dollar. The only one which is like that is situation BB. So how do I use the present value of an annuity of $1? So my payment amount, which is the same every year, is going to be $10,000 right over here. So this is going to be 10 grand. Now, over here for this particular question, what I can now say is like, okay, if I use the present value of an ordinary annuity of $1, what I want to know are two things. What is the interest rate and how many times is it being paid? Well, it's being paid 3 times. At 12%. So when I come over here to this table, present value of an annuity of $1, 3 periods at 12% is 2.40183. So if I multiply this over here, that's 10,000 by 2.40183, I'm going to get 24,018. My initial investment is 22,000. So my net present value is going to be 2018. Is this the same number? The answer is yes. So what's great about this table over here is that if we have the same dollar amount being paid year after year, we can go through ahead and use this present value of an annuity table. So over here, we can't use it up here because it's not the same dollar amount year over year. We can't use it here, but this is how we're going through and doing it. Now with net present value, this is the one that is by far the most important concept. On the future videos, I'm not going to go into this much of depth. So if you're looking for a better explanation, I would go look at my bonds videos, but that should hopefully get you started on this for today. And I look forward to seeing you on the next video. I want to thank Wiley again for allowing me to use their material. Much appreciated. Please don't forget to like and subscribe. And if you're looking for other solutions to anything that's a Wiley product, I can probably help you out. Have a great rest of your day.